Good morning, good afternoon, and especially good evening to the viewers in Asia, since it is 9 p.m. back home in Hong Kong, and welcome to our third AFC Fund webinar. My name is Thomas Hugger, and I'm the CEO and founder of Asia Frontier Capital. With me today are Ruchir Desai in Hong Kong, who is managing with me the AFC Asia Frontier Fund. Ahmed Tabakchali, the chief strategist of the AFC Iraq Fund, is today in Baghdad, Iraq. Scott Osherhoff, the Chief Investment Officer of the AFC Uzbekistan Fund, joins us from Tashkent in Uzbekistan. And Vincente Nguyen, the Chief Investment Officer of the AFC Vietnam Fund, is based in Ho Chi Minh City and will update us about the situation on the ground in Vietnam. This webinar will last about 45 minutes, and thereafter you will have the opportunity to ask questions during our 15 minutes Q&A session after the presentations. You can submit your questions online through the Q&A icon at the bottom of this Zoom window. In 2022, there was never a dull day in our AFC universe. The year started with social unrest in Kazakhstan, followed by political and economic issues in Pakistan and Sri Lanka, and globally the conflict in Ukraine, which led to higher commodity and energy prices, and more importantly for financial markets, to higher interest rates, which impacted especially the global equity and bond markets negatively. The turmoil has also impacted our AFC funds negatively, but on the positive side, they all trade now at PE valuations which are at or close to all-time lows, and we view this now as an investment opportunity. But let's listen to our fund managers first. Ruchir Desai will now provide us with an economic update and investment outlook for the Asian frontier markets and the AFC Asia Frontier Fund.
Great, thank you, Thomas, and welcome everyone to another webinar that we are hosting, which we do every quarter. And as Thomas mentioned, it's been a very interesting year and continues to be an interesting year. So let's dig right into it. What I'll do is I'll probably spend a couple of minutes just on macro and top down, because that's pretty important as to what's going on in the US and also globally, and it's impacting pretty much all the markets, including our universe. So as this slide shows you, I mean, inflation has been the biggest headwind or the talking point amongst investors, even before the war in Ukraine began, but of course, much more after the war in Ukraine began earlier this year. But I think the most important part is how inflation the US has been doing. It's been coming in ahead of estimates pretty much every month since the summer. So that's been a key headwind and also a key talking point for investors. And moving on, as the next slide shows you, that has made the US Fed obviously much more aggressive, much more hawkish than what probably investors anticipated at the start of the year. And since the last time we spoke in July, the expectations for interest rates in the US have picked up quite significantly, as this chart shows you. I'm not an expert on the US economy, but my 2 cents are that the market now expects, so I guess most investors already know this, that the market expects the Fed to raise rates to close to 5% over the next couple of months. And let's see when they're done with raising interest rates. So clearly the narrative has moved from lower for longer to probably higher for longer. So in all probability, the US Fed will raise rates to a certain extent, and then we'll probably hold them before there's any talk of even cutting them. So I think you can expect interest rates, at least in developed markets, to remain higher going in the foreseeable future over the next couple of quarters. And also going ahead, as the next slide shows you, it's not just about US interest rates. It's because of high interest rates in the US and I guess because of uncertainty in the global economy, there's been a flight to safety, and the US dollar has been extremely strong this year, as many of you may be aware, and that's impacted not just currencies across the world, both in developed and developing markets, but also it's affected stock markets, as this chart shows you. I mean, it's not been a great year for frontier or emerging markets, not only because of what's happening to the economies in these various countries, but also because of the dollar strength, and that's impacted market sentiment significantly and led to outflows in many emerging markets and some frontier markets as well, and led to pretty big drawdowns in the last couple of months. Moving forward, I think one taking a bit of a more longer term view or medium term view, inflation numbers in the US probably will come in higher than expected, given the low base from last year, at least till the end of this year. But hopefully, if we move towards, say, the second quarter of next year, then inflation numbers could peak out because of the base effect. That's just the best guess, educated guess that I'm making, looking at the numbers and looking at various other indicators which are moving around in terms of supply chain and food costs and oil and gasoline costs, which have been coming off. So hopefully inflation peaks out by first half of next year, and then maybe the Fed has also done with raising interest rates, and then hopefully we see some kind of, well, not favor, but at least less hawkishness from the US Fed. Moving on, as I was mentioning, interest rates have basically risen pretty much across the board, not just in the US or developed markets. But as this chart shows you, many of our markets actually, or many central banks in our universe, have raised interest rates pretty aggressively, and many of them raised interest rates even before the Fed began raising interest rates. So, for example, Pakistan began raising interest rates last September quite aggressively, and many other markets also have been very aggressive in raising interest rates, like Sri Lanka or Kazakhstan. So in my view, I think many central banks in our universe have been pretty aggressive in any case, given the high inflation numbers in the economies. And they've been raising rates much before the Fed began their hawkish moves in the last couple of months. And also there are some economies where the economics is doing quite well. GDP growth has been pretty good. Currency has been pretty strong. There are some countries, in my view, which actually would cut interest rates next year. And in the prime example is Georgia. It's a small economy relatively, but I think overall their GDP numbers have been great despite the conflict in Ukraine. They've seen remittance inflows, tourism inflows. In fact, the currency has been very strong this year, and inflation numbers are actually coming down in Georgia now the last couple of months. So I would not be surprised if central banks in our universe, because they've been so aggressive in the last probably 12 to 15 months, and because they're seeing an improvement in some economies are seeing an improvement, they would be the first to cut probably second half of next year, hopefully, which should be good for economic and stock market sentiment in our universe. And moving ahead, just in terms of some of the inflation indicators, as I mentioned earlier in my talk, let's see how it goes going forward. But if you look at many of the commodity prices, they've been coming off quite significantly since the prices peaked when the conflict in Ukraine began. So especially crude oil prices have come off from $130 to about $85, $90 now, and also natural gas prices have come off significantly. That should really help many of our economies because many of them are energy importers, and that really helps the current account if energy prices come down. And also food prices, as the next chart shows you, have come off a lot. Of course, you can't really compare to food costs maybe 18 months ago or pre-pandemic levels. They're still very high. So some amount of elevated costs will remain, but they've come down from where they were probably in March and April of 2022. That again helps many of our countries in our universe to balance the current accounts, because countries like Bangladesh and Sri Lanka and some of the other countries in the universe, they import a large part of their food, for example, like wheat, which is a big staple for these countries. And that really helps, and these lower food costs helps reduce the current accounts and also helps reduce inflation. So this is actually a good sign for our universe going forward. Also, some more cost inflation indicators, as the next chart shows you, freight rates have come down significantly since the peak of maybe a year ago. This is the 40-foot container pricing index, which has basically crashed in the last couple of months. That again is very positive for pretty much all our markets, given the fact that it also helps bring down inflation and manage inflation expectations going forward. So overall, yes, interest rates are high, inflation is high, but the indicator suggests that in many of our markets, we could see inflation peaking out by probably beginning of next year in the first quarter. Moving ahead. So yes, I mean, having said that, things are not as rosy as probably what I was just trying to elaborate on, but IMF just recently cut global GDP growth forecast a couple of weeks ago in their latest outlook. As the chart on the top left shows you, it's there were cuts pretty much across the board. And for our universe, GDP growth for 2023 was cut by a little more than 1%. But it's pretty much, I don't think any country is immune from what's going on globally at this point in time. Having said that, as the chart on the top right shows you, there are still many countries, despite the GDP growth downgrades, there are still many countries in our universe which will show pretty strong GDP growth next year. Countries like Bangladesh, Pakistan, Bangladesh, Vietnam, and Cambodia will do 6% plus GDP growth. And even Central Asia, which is has been basically benefiting a bit from the conflict in Ukraine. Is showing about many countries are showing between 4 to 5% GDP growth, which is I think healthy given the global conditions. And also going forward in the long term as well, as the next slide shows you, it's not just about GDP growth next year or economic growth next year. As the chart on the top left shows you, in the longer term, this is after the downgrades happened a couple of weeks ago. Longer term, over the next 5 years, GDP growth in our universe is still pretty healthy, and I would say higher than many of the regions, as the chart on the top left shows you. For example, it's higher than Middle East, North Africa, higher than Latin America. These are where many of the frontier markets are located in, but our universe is still doing pretty well because of good and solid growth rates in Bangladesh and Vietnam, which will do more than 6% GDP growth quite comfortably over the next 5 years. And also, as the chart on the top right shows you, this is the debt to GDP levels for many of the countries in Asia and also in our universe. I think most countries, I think, like I said earlier, I think no country is immune from what's going on globally in terms of rising inflation or rising interest rates or the geopolitical issues that are happening right now globally. But I think some countries will not obviously be able to manage the situation because we've seen the case of Pakistan and Sri Lanka. But over here, if you look at this chart, debt to GDP levels for example, Kazakhstan, Bangladesh, Uzbekistan, Vietnam are still pretty low. So they'll be able to manage. Yes, they'll face headwinds. There'll be high inflation. There'll be higher interest rates. Consumers will get squeezed. But I don't see them, becoming the next Sri Lanka from any angle at this point in time. So they'll be able to manage. And I think that's where I think many of these countries will stand out. So I think one should focus on countries, at least on a macro level, who can manage the current headwinds over the next couple of quarters. So I think these countries really stand out in being able to manage the situation because of the low debt levels. And also going ahead, I think importantly, it's not just about the GDP growth downgrades or the negative macro impact on the global economy. There are also some good things happening in many countries despite what is going on globally. And as this chart shows you, the chart on the top left, this is Georgia. I'm talking about Georgia here. The tourism revenues in Georgia basically have gone back significantly ahead of pre-pandemic levels. In fact, more than 100% of pre-pandemic levels over the last couple of months. This is because of the conflict in Ukraine. Many Russians and Ukrainians have moved to Georgia, I would say permanently, and that's really helped the economy and also the tourism sector as well. And also, as the chart on the top right shows you, remittances have come in a large way, especially from many Russians who are leaving Russia and moving into the region like Georgia, Uzbekistan, and Kazakhstan. Maybe even Azerbaijan to some extent, and obviously they're remitting their funds into these newer markets, so it's helping build up FX reserves in countries like Georgia and also supporting the currency. In fact, the Georgian lari, which is the currency of Georgia, is one of the few currencies which has actually appreciated this year. So I think given what's going on with the dollar, it's very rare to see some currencies in emerging markets do well, but Georgian currency actually has done very well, and the central bank actually is trying to make sure the appreciation is not too much. So that's the opposite from what other central banks are doing globally at this point in time. And also, it's not just about Georgia. I would say even the region in Central Asia, as the next slide shows you, is benefiting a lot from what's going on in between Russia and Ukraine. The first example I would like to give is of Kazakhstan. Xi Jinping, for his first visit post-COVID, the first country he went after, the first country visited post-COVID was Kazakhstan. That's a pretty big, strong message that he's sending to Russia in terms of, controlling or managing Chinese interests in Central Asia. And also Kazakhstan basically sending a message to Russia that China has our back in terms of geopolitics. So I think there's some significant developments going on in the region. And also, as the chart on the top right shows you, Kazakhstan at some point in time on the long term will clearly need to diversify their oil export routes. Currently, pretty much all their oil, or 80% of their oil, is exported via the CPC pipeline, which runs through Russian territory via the Black Sea port. But eventually, I think that will change given the fact that Russia has some leverage over them. And so they're looking at routes via China and also via the Caspian Sea, which goes through Azerbaijan, Georgia, and Turkey. That will take some time, but eventually I think it'll happen. And therefore, I think you'll see more and more Central Asian countries benefiting from what's going on in the region. And even Azerbaijan, we don't cover Azerbaijan because, there's not we can't really invest in how many listed stocks on the stock market. There's seen a lot of demand for gas from Europe as Europe tries to wean away from Russian gas. Overall, I think in my view, Central Asia is a region to look at or to keep in mind going forward, which I think will benefit a lot over the next couple of years and see pretty stable growth. And also, as the next slide shows you, it's not just about Central Asia. I think these are some slides which I've spoken about previously in my webinars or in our webinars. The manufacturing shift from China into many Asian frontier countries is still happening. It's still going on very strongly despite concerns about slower growth in the US or Europe or geopolitical tensions, etc. And I think I would focus more on the chart on the top right because that's more important. That's the chart which shows you the garment exports to the US. And this is after the trade war with China began, between the US and China began in 2018. So as the chart shows you, China has lost a lot of market share in the US garment export market. And that market share has basically been gained by Vietnam and Bangladesh, not India or Indonesia. It's basically Vietnam and Bangladesh which have gained the market share quite significantly, actually, as the numbers show you. And actually, despite all the talk about US having a recession this year, Bangladesh's garment exports to the US have grown by more than 50% in the first 8 months of 2022. And also within the EU, Bangladesh is now a close number 2 in the garment export industry after China. In fact, in the first half of 2022, China's garment exports to the EU were about 12.5 billion. And for Bangladesh, they're about 11.2, 11.3 billion. So pretty much catching up to China as well. So as I mentioned, Vietnam and Bangladesh, I think are two standouts in terms of benefiting from the manufacturing, especially the garment manufacturing shift from China into these countries. But as the next slide shows you, Vietnam obviously is more diversified. It's not just about garments for Vietnam. They are the clear beneficiary from the supply chain diversification, supply chain push. And as the chart on the top left shows you, which I've spoken about previously as well, exports from Vietnam to US have seen an increasing trend, especially post-pandemic and especially when tensions between the US and China really picked up post-COVID-19. And it just shows you how important Vietnam is now as a supply chain partner to the US. And as the chart on the top right shows you, FDI has been consistently at about $21 billion the last 4 or 5 years and 6% of GDP. So clearly, FDI continues to come in into the manufacturing sector. And even companies like Apple and Samsung are now doing more higher-end products or plan to do more higher-end products in Vietnam. So clearly there's a shift for Vietnam from doing just basic goods like assembling smartphones or doing garments to doing more higher-end stuff, which is actually what they want to do in the long term. So they're also moving in the right direction as well. Moving ahead. So that's a bit about the macro supply chain diversification, which countries are benefiting from the supply chain shift, etc. I think I'll spend a few more minutes now on basically our portfolio, what's happening in our markets, and also on valuations. So as this table shows you, these are some of the top picks in our AFC Asia Frontier Fund. Firstly, all these companies are blue chip companies in our markets. They're well known, well established, strong brands, strong pricing power. They've been around for a long time. But I think more importantly, what you should look at is the third last column from the right, which is the P ratio for 2023. So it takes into account probably some earnings decline or earnings pressure for next year as well. But all these multiples, despite probably slow economic growth and earnings cuts, etc., over the next couple of quarters, all these multiples are less than 15 times, less than 15 times. There's clear value on offer, and actually most of them are less than 10 times. And there's clear value on offer. And these are not just low P ratios with a low ROE. I can understand if the ROE or the return on equity on these companies was 5% or 6% or 10%, and they had a low P ratio, understandable. But if you look at the last column, the ROEs for basically majority of these companies is 25% or more, and some at 20% and some below 20%. But majority is 25% or more. So these are solid businesses doing good, decent growth rates over the long term and available at very discounted valuations. So I think many stocks on a bottom-up basis in our universe are just too cheap to ignore, and eventually they just need a positive trigger to re-rate them going forward. And as some of the next slides show you, which I talked about, the P ratio for our AFC Asia Frontier Fund is now at 7.3 times. That's pretty much the lowest it's ever been, but it's even more importantly, it's even lower than the P ratio was in March 2020 when the pandemic just began. So I don't think the situation right now is as bad as what situation was that time in March 2020. The economy is still open and many companies are still doing good business. So clearly, if the interest rate cycle turns in our markets and the PE multiples expand, say next year in the first half, I think there's a clear case for making a decent return over the next 12 to 18 months in Asian frontier markets and also in the AFC Asia Frontier Fund. And just some more slides on valuation, which I'll talk about in the next slide. If you look at even the MSCI Frontier Markets Index, the maroon line, trades about 8.1 times trailing 12 months earnings. This is basically, if you look at this is a longer term chart, and the bottom shows you the calendar years below. And basically, we're back to where we were in 2008 at the global financial crisis. So even basically what I'm saying is the stocks are at all-time lows in terms of valuations, and even the markets are pretty much at, I would say, all-time lows in terms of valuations. So we are pretty much at the bottom at this point in time. And also, as the next chart suggests, the discount from the S&P, this is the MSCI Frontier Asia Markets Index P ratio divided by the S&P 500 P ratio. Basically, it's at a 50% discount. And since the data is available, it's the cheapest it's ever been in terms of the discount to the S&P 500. So clearly, another indicator that we're pretty much close to the bottom. While fundamentals on a company basis remain extremely strong, yes, on a macro level, like I said, everyone's going to face a headwind. So you can't really argue that there's no headwind. Yes, there are. But like I said, the countries which can manage will manage, and they're managing pretty well, and they'll be able to survive. But the companies on a bottom up are surviving, and in fact, many of them are thriving by taking market share and even becoming stronger. And as the next slide suggests, shows you, I mean, the fundamentals of our portfolio is fine. I already spoke about the PE ratio, but the earnings growth the last 3 years has been about 17%, so close to 20%. Return on equity, which I mentioned to you as well, close to 25%. So fundamentals are completely fine. Debt levels are not high. In fact, many companies in our universe, they don't have much debt, and whatever debt they have is all local currency. So there's no concern about if the local currency depreciates and they have to pay more interest. So that's not really a factor. So I just want to wrap up the next couple of slides. If you can move forward. This is just a brief on our country and sector allocation. You can get more on this on a fact sheet, but I'd like to spend more time on the last slide, which is my key message from this webinar. So I think what are the key takeaways or key messages that I would like to give as I finish my talk is yes, things are not great at this point in time, but I think what investors should look out for is signs of inflation and interest rates peaking out, which I think in my view will definitely get in the next 3 or 4 months. The 2022 was the year of higher inflation talk, but I think 2023 can be the opposite. Inflation not coming down to 2% of US, but at least coming off the levels that we've seen this year because of supply chain pressures coming off and commodity prices coming off, and also the base effect comes into play. And this ties into my earlier discussion that valuations are just too discounted now. Fundamentals are fine on a bottom-up basis. So all the markets need and all the stocks need some kind of positive trigger, and that trigger will come when there's indications that inflation has peaked out, interest rates have peaked out. And also, I think 2023 will be more about stock picking. This talk about these macro headwinds, high inflation, debt levels, geopolitics, that's going to remain with us for the next couple of years. So I think next few years is all about stock picking, and we have some very good stocks in our portfolio. And I think just to end, I would say this uncertainty is here to stay. So I think you'll see noisy headlines going forward as well, US-China tensions, inflation, interest rates. But the idea is to focus on the fundamentals, and the bottom up is very strong. So I think this is the time to look at investing in Asian frontier markets with probably a 12 to 18 month view. So with that, thanks for listening to me. Happy to answer your questions at the end of the webinar. And with this, I'll hand over to Ahmed Tabakshali, who will talk about our AFC Iraq Fund. Thank you.
Thank you, Rusha. Much appreciated, and thank you all for joining us on, as Rusha said, our third. Thomas started with the observation that this year has been a full year for our funds. Actually, in fact, for all the markets. I think the last quarter, and that's about to begin, is going to be looking as horrible. I think you've all are aware of what's going on in the world, but I would like to draw your attention to something just I saw last night, which is, or this morning, very relevant to what I'm talking about in Iraq. This morning, the reports came in on Amazon's earnings and the warning they have. But the point that they mentioned, which is really sort of, I think, that we all having to deal with, is the fact that they've mentioned that they are into uncharted waters when it comes to consumers, and that's mostly consumers as well as businesses. The thing is, for Iraq, we've had uncharted territories for the last 7 years or thereabouts. I think whatever's happening in the world, if there is one country that has seen it all and seen far worse than that, it's been Iraq and its equity market. And in a way, that's what you're seeing in the year-to-date performance of the fund, up 2.6% on that. Can I have the next slide, please? So as I said, basically, this is something that Iraq has seen over the last 5 years, from almost the loss of a third of the country, 2 oil price crashes that pretty much sort of almost ended it, and to sort of all the stories that you've been hearing about Iraq. But what you might not know is Iraq, or the Iraq government, is one of the few governments worldwide, if not, I mean, yeah, few compared to maybe some GCC countries, that is in a position to increase spending. If you all recall, in 2020, when we had the massive lockdown and the economic effects of COVID, the world countries have all pumped enormous amounts of liquidity into the economy to help the consumers. Well, this time nobody's doing it. If anything, everybody's raising interest rates and working on restrictive monetary policies. Iraq is the reverse. In June, we've passed a supplementary budget, which effectively increased spending by about 23% year to date. And all of that is taking part in the second half of the year. So it's one thing, in a way, in this environment, to be able to spend on the economy. And I think we're going to see far more spending in the next few months, as I'll explain later. Now, the points I want to show you here are the few charts. And the first one is on the amount of money in the economy, and that's the top right-hand corner chart. We've had an acceleration of that in the last couple of years from government borrowing and spending, but we had a bit of a slowdown in the last few months in that, and that's primarily because we didn't have a government. We have a government that was formed finally after a year of negotiations yesterday, and that should have positive on spending, and I'll explain later. But so without a budget, the supplementary budget was quite crucial, and what it shows us is clearly beginning of acceleration or beginning of growth in the amount of money in the economy. And that's not, I don't have a chart here, but that's also reflected in credit extended to the private sector. It should all point out to increased consumption, and that's clearly can be seen in the second chart, the right-hand side chart at the bottom, which is basically trade finance, the private sector banking that are providing trade finance and companies for the country. In a country like Iraq, where we import almost everything from the outside world, this clearly shows you a substantial recovery after many years of decline. The last time we had levels like this was in the last boom, or the last super oil cycle, which was, as you all recall, ended in 2014. And now we're getting back there, and it could be quite substantial. The reason why I mention that is also to show you, in a way, the effect of government spending. Iraq is one of the few countries that is actually pretty much probably the most leveraged to oil prices, and also leveraged to government spending. The government spending is pretty crucial. As I mentioned, the government was formed finally last night, after an enormous debate and sort of political conflict and paralysis over the last 12 months. One of the key features of the government is that the legitimacy of the government is in question primarily because of the low electoral turnout in 21. Given the bounty, currently right now, Iraq is sitting on an enormous amount of foreign reserves as well as budget surpluses. Almost all countries in the world are, especially emerging market countries, you look at their foreign reserves, they're all declining. Iraq is the reverse. We are the highest that we've ever seen and likely to increase. And I'll give you some figures in a minute or so. But as you can see here, our non-oil GDP, which really what matters and what drives the earnings of our companies, is on the rebound. We've had a very strong figure at 21. Obviously, that was an effect of a recovery from a sharp decline, but we're seeing growth in there. The IMF released some updated figures on the expectations of non-oil GDP, and it's expected to be something like 4.4% this year and something like 3.8% next year. I think it's going to be substantially higher. primarily because of the government incentive. There is an enormous reason to expect that we will see a very expansionary budget, almost like a giveaway budget for the government and the governing coalition right now to almost regain legitimacy, which should accelerate spending. Now, I'll just give you some figures there to show you where we are. And I've mentioned reserves. We are currently at 11.5 months of reserves. We're likely to be about 14 months in 23. Current account, we are 16.3% of GDP, likely to be 13% of GDP, but keep in mind, the 13% is not an absolutely smaller figure because GDP is going to be substantially larger. In all of this, by the way, our inflation, unlike many other countries, is very, very low. Currently, inflation overall is expected to be 6% this year, peak at 6.5% next year, and then decline after that. So macro-wise, spending-wise, the picture is absolutely amazing. Where does that put us in terms of the market? If I can have the next slide, Peter, please. Right. Where we are right now, those of you who are watching Iraq or watched Iraq, we've been in a severe bear market, a multi-year bear market over the last few years. In fact, anything, we were down almost 70% from top to bottom there. And also even now, after good returns last year and decent returns this year, we're still about 61% versus the 2014 high. Now, compare that to other markets worldwide, and I think you'll see a very, very different picture. I believe Iraq is far more attractive than any other country and oil market, forgive me. But also, you're aware markets discount, and that's why prices are down. But given the fact that we are in uncharted territory, that the energy crisis faced by countries is affecting all kinds of stuff, the markets worldwide, I believe, haven't fully discounted what can go wrong. On the other hand, Iraq is just at the beginning of that, and I think that's really where the attractive risk-reward ratio for Iraq is. As I mentioned, the macro fundamentals are very strong. Domestically, we are likely to see increased spending this year and next year. So that will provide a boost to consumption, a significant boost to consumption, to money growth, and that will drive the earnings for all our companies better. And also, all our companies have adjusted to, as I mentioned, a 5 years bear market, because the bear market was not only in equities, but also in our economic performance. And I think with that, I've almost used up my time. Thank you all very much, and I look forward to hearing your questions. And I now pass you on to my colleague who runs our Uzbekistan fund, and that's Scott.
Thank you. There we go. Hello, everyone. So Uzbekistan is doing very well. The macro story continues to get strong or get stronger. In the first half of the year, GDP grew 5.4%. It's accelerated now to 5.8%. Meanwhile, when you look at the rest of the world or compare Uzbekistan to the majority of the rest of the world, which is experiencing an economic slowdown in one way, shape, or form, as well as sticky inflation. Uzbekistan and also you're seeing in the developing world pressures with a strong dollar. The currency in Uzbekistan is only down 3% year to date, which is the strongest the currency's been since we started investing here in 2018. And inflation's about 12%, which is not great, but it's down from about 20% when we got here in 2018, and it's been in the 10 to 12% range for the past 2 years. So all in all, things are quite good. Meanwhile, exports are up 36% and imports are up 22%. So our thesis has been over the past few years is the country continues to industrialize, exports will continue to outpace imports, and in due course, the trade deficit will begin to narrow. And also, if you look at, of course, with the war in Ukraine, you've seen a huge amount of Russians, Belarusians, Ukrainians, which have flooded into Central Asia, as Ruchir mentioned, along with Georgia. And I was reading earlier today that there are about 318,000 Russians that have relocated to Uzbekistan this year. So it's a huge number. And the majority of them are skilled labor. So you're seeing a lot of tech companies and multinationals relocate to Central Asia. Kazakhstan's really location number one, followed by Uzbekistan. But you have an IT park here. So you have a lot of services companies that are relocating, thousands of people. that are making good money, and they're helping to drive consumption and also employment in the country. And I look at this as really a great thing for the country, because one of the big challenges that I've seen since I've been here is you've had this perpetual brain drain, like in all former Soviet, countries, and the majority, well, a lot of people that are in their 20s and 30s are moving into the world of tech, whether it's programming, digital marketing, etc. And historically, there were not a lot of jobs here, so everyone seemingly was looking to move abroad for opportunity. But now I'm seeing a handful of them actually stay here, get good salaries, working in a lot of these companies that have relocated. And hopefully in due course, they realize that there's more opportunity here than in places like America or throughout Western Europe, and they start their own businesses here. So yeah, on the macro side of things, Uzbekistan is doing very well. Moving to the capital markets. So in September, we got a new CEO, and I like to say that he's really the first CEO the stock exchange has ever actually had, because all the former CEOs of the exchange were government bureaucrats. So George Parsashvili is the former CEO of the Georgian Stock Exchange, and he was integral in developing the Georgian capital markets, including getting a handful of companies such as TBC and Bank of Georgia listed in London, introducing the Euroclear and Clearstream networks to the Georgian exchange. So I'm very excited that he's here. And hopefully over the next 6 to 12 months, he's able to catalyze a lot of change for the market. And I've had rather consistent dialogue with him. He knows exactly what needs to be done. And in a few weeks, we're hosting sort of an internal roundtable with some local market participants to discuss the issues that perpetuate on the stock exchange in order to address them. So I'm very encouraged by his presence here. Then we have some more detail, if you will, on the capital markets legislation, which I've mentioned in some of our written updates over the past few years. And it should have been passed already, but initially this legislation was specific to the stock market. And speaking with people in government, it sounds like there's now more of a focus on building a true framework for the broad capital markets, everything from mortgage-backed securities to REITs to index funds, developing the bond market, the treasury market, etc. So this is probably going to take another 6 to 12 months to get passed, but once it's in place, we should have legislation that is a true foundation for the entire capital markets and won't need to be updated every 6 months, which, understanding how laws and regulations are passed in this country, they take a lot of time. So it's encouraging that they're willing to slow down, which is not what I've seen a lot of frontier markets do. They tend to rush and trip and then fix things as issues arise. So the fact that they're working with the European Bank for Reconstruction Development to get it hopefully right the first time is very encouraging. And then in relation to the stock market in terms of trading and whatnot, some really interesting things have been happening. Our thesis has always been get here first, buy good companies, the quasi blue chips at cheap prices, and in due course, as people realize what's happening in Uzbekistan, they'll come, they'll invest, and you'll have that re-rating. And we already had an initial phase of that re-rating about 1.5 years, 2 years ago. But the past few months, really the past 2 months, has been interesting from the standpoint of we've been approached probably a half a dozen, if not a bit more, times by local and foreign investors that are looking to buy blocks of our stock. In some cases, blocks that our entire share in these companies. And they're willing to do it at decent premiums. So we exited one company this month at a 45% premium to our average price. A 45% premium to the market. It was about 120% premium to our average price. And then we're in negotiations for a few more blocks. Additionally, we're seeing a lot of Russian and European money begin to enter the market, which again, we've been waiting a long time for. So we're very encouraged by some things that should happen in the market over the next few months. With that, I'll pass it over to Vicente Nguyen, who will be discussing our Vietnam fund.
So good evening, everybody. Thank you very much for your time. So actually, maybe all of you already seen that Vietnam stock market was one of the worst performance in over the world in the last few months when the index lost more than 30% from the peak. So maybe in your mind, you can think there's something wrong with the economy or not. There's something wrong going there in Vietnam, but indeed, there's nothing wrong with the economy. If you look at the economy, Vietnam has a very impressive economy performance in the third quarter. In the third quarter, the GDP growth hit 13.7%. This is the highest in at least last 2 decades. So because it's from the low base in 2021. However, if you look at on the aspect of the whole economy, you can see that a great improvement in industrial productions, especially in FDI disbursement. We already attracted very good FDI investment. So in the third quarter, FDI increased 16.3%. Export, even though it slowed down a little bit in the third quarter, but it still have very impressive growth with 17.2%. And if you look at the retail, you can see that after the COVID-19, Vietnam economy has really come back to the normal activities when everybody went out, consumed things, buy things, and started to reactive their normal life. So retail activity increased 21% in the third quarter. This is very impressive. Meanwhile, the government is quite successful in controlling the CPI. Maybe CPI is one of the most serious problem in the Western economy, but in Vietnam it's still under control. And I think this year in 2022, CPI will around 4% is mean that the target of the country. So everything is getting better. The only thing is getting worse in the stock market. So the economy is going up and the stock price is getting down. It's serious. So actually this offer also very great opportunities. So Peter, can you move to the next slide, please? If you look at the charts, you can see that the valuation of Vietnam markets right now is very attractive. 12-month forward PE is around 9 times on earning only. So the economy is going up, the earning of the listed enterprise going up, only the stock price getting down. So it's offer a great opportunity. If you look at this chart, you can see that there's only 2 times when the PE of the valuation, the market hit around 9 times is when we started the fund in 2013, in late 2013, and you all know that how we make our performance in the last 8 years, nearly 9 years. And another time is the COVID-19. During COVID-19, everybody have very negative outlook about the world, about everything, and they shown off at very low price, low level, and everybody has known that how the market reacted after that. It created a V-shaped recovery and the markets went up aggressively. So you might miss the opportunity during COVID-19, and now the opportunity appear again. So I think this is very attractive level to enter. You know, on the Vietnamese stock markets right now, there are hundreds of stock with the PE below 5, especially in the banking sector. More than 50% bank stock with the PE below 5 and PP below 1. You can imagine that? It's incredible. So I think this is a good opportunity. The reason why I myself, and Andreas Morgensenker, the CEO of AFC Vietnam Fund, and even Thomas of AFC Group, we all 3 of us decided to invest it into the fund this month because I think that this is a very attractive plan. The most important thing that we can argue, okay, we can see opportunity, but how AFC Vietnam can capture this opportunity? Peter, can you move to the next slide? So as you know, in the last 8 years, we already outperformed against the index. Even in the first 9 months this year, we also outperformed the index when we down only 15%, but index down 25% in the first 9 months. Actually, so the reason why we strongly believe that we can do it. We can continue to capture these opportunities when the markets recover. So the PE of the fund is right now also quite attractive, below 9 times. Especially you can see that the dividend yield is 5.1%. So we actually invested into the sector with, how to say, safe, a very safe level. Let's say, I will tell you the story about roughly 1 year ago when we saw a little bit risk in banking sector, and we decided to sell the bank stock and buy insurance sector because we think the interest rate already hit the bottom and the interest rate has to increase again. And when the interest rate increase, insurance sector will benefit a lot because 90%, more than 90% profits of the insurance sector come from the deposits at the bank. So when the interest rates went up, insurance company will benefit. The reason why in the first 9 months, insurance sector outperformed quite a lot against banking sector or even other sector, and the whole index is really support us in the first 9 months. And besides the insurance sector, we also invested into allocate our portfolio in tourism sector because tourism after COVID-19 recovered strongly. The reason why we have 2 positions in our portfolio that recently just launched their report that the net profit increased 14 times, and even the net profit surpassed the pre-COVID level. So a reason why we strongly believe that AFC Vietnam Fund can capture the recovery and this opportunity. So thank you very much for your attendance.
Yeah, and thanks everybody for your interesting and insightful presentations. We will go now to answer some of the many questions we have already received from the audience. But you can still submit more questions during this Q&A session, which will be a little bit shorter today, maybe 12 minutes only. Okay. Yeah, many questions regarding Vietnam, Vicente. I try to put them a little bit together.
Okay.
So why did the Vietnam index fall so much this year? What is the story? What is the underlying reason for it, and so on? And then, yeah, somebody else wrote, "I'm considering to invest in the AFC Vietnam Fund. Is it now the right time to buy?" So maybe if you can talk about this.
Okay, so maybe everybody will wonder yourself that everything is getting good. So why the market is getting down? But actually, because this year, Vietnamese government conducted some investigation on the stock market, and they already arrested some manipulator on the stock market. And this intervention of the government really created some chaos on the market, and it's make the investment sentiments of local individual investors very weak, you know, because in Vietnam, 90% daily trading is contributed by local investors. As you know, last year, more than 3.5 million new accounts created in the last 2 years, and they really support the markets running up. But most of them are, I'll say, they do not have enough knowledge or experience on the market. So when they got fear, they sell off everything at any price. They got really fierce, and so it creates a very bad investment sentiment. So the reason why the market fell aggressively because local individual investors itself every single day. And if you ask me, is this a good time for enter Vietnamese market? As I said before, I and myself and Andreas Bugensinger and Thomas decided to invest into the fund this month. I have to close my eyes, close my ear, and forget on the rumor on the market and just think about the fundamental of the company we are investing and the economy in the next 3-5 years. And absolutely, I think this is a great opportunity because sooner or later, the fear of local investors will disappear and the markets will recover. So, and this is good opportunity for long-term investors. We do not know about a short-term, maybe 1 month, 2 months. It's very hard to predict, but long-term is absolutely, you can, I think so. We can make quite nice profits.
Okay, thank you very much. Yeah, as I said, I also invested, so let's hope. But I'm pretty convinced it's a good time to invest if you ask me. Here I have a question for Scott. It's from one of the listeners. This fund interests me greatly and has increased my interest. With that said, my question is for Scott. There are several state-owned enterprises that, to my understanding, are going public soon. Will your fund be taking a bit, so to speak, in these offerings? What do you think of companies such as Angren Pipe Plant, Dori Darmon, and JSC Humans companies? What companies will benefit from these increased exports? Usmet-Kombinat, Kieselkum Cement.
So there are about 20 companies or 22 companies which are slated for privatization through the stock exchange. The list sort of keeps growing. Ultimately, we'll see what actually gets privatized. For those 3 companies that were mentioned, the Angren Pipe Plant, I'm beginning to look at. The other 2, there's not too much interest in them from us, but certainly with some of the privatizations, we'll be looking to take a stake if the price makes sense. These are sort of the crown jewels of the economy, natural gas distribution companies, manufacturing companies. So if the price makes sense, we'll certainly be looking to participate. And then from an export angle, Usmet-Kombinat, Kieselkum, Navoi, the gold company, and Al Malik as well, the big copper company. So all these companies will be, in due course, as their capacity improves, they'll be increasing their share of exports. So for example, right now, Usmet-Kombinat, I think maybe 5% of their production is exported. In due course, once domestic demand for steel is satisfied, you'll see incremental production be exported regionally.
Okay, great, thank you. Then one for you, Ahmed. I experience your outlook on Iraq as very positive. Don't you see a big risk if, due to a global recession, oil prices go down again?
Well, thank you for that. That's a very good question. And yes, in normal circumstances, GDP growth, global GDP growth is very much or greatly correlated with oil demand. And certainly there will be demand destruction. There will be weakness in demand. There's no doubt about that. However, this time around, and okay, one should be always very careful when you say things are different, but this time around they are different, and I think for 2 particular reasons. One is the invasion of Ukraine has changed or upended the whole sort of like world order in so many ways. You don't want me to go into that, but I think one of the crucial thing about it, it adds another dimension to energy demand, and that is the question of energy security. Yes, very much long term, it will encourage the shift to non-oil product, but in the medium term, it means companies and countries will need to store oil and need to have more and more oil. So that will counter the effect of that. And the other one, by the way, the other reason is the oil market dynamics are not what it seems. By that, I mean the supply and demand balance is very much in the favor of demand, even much weakened demand. You might recall that OPEC about 2 or 3 weeks ago, they cut production by about 2 million barrels a day, and there was a big uproar about that. In fact, the effective cut was about 1 million, not really 2 million. And the reason being is that most OPEC countries, including the OPEC plus countries, are at peak capacity. They cannot increase capacity whatsoever. That's why it's actually the effective one is 1 million. So net, what I'm trying to say is you have very much weak growth in non-OPEC supply. Even the US is only going to get back to pre-COVID levels by end of next year, if that. So you have very limited in terms of supply. You have demand that even much weakened is probably more of evenly balanced with oil. And then you have the macro picture in terms of the energy security that comes in. So net, those of you who might have read my reports, I've always said when oil prices shot up, I've always said these are unsustainable. I was always looking for much lower oil prices. So this year, the average will probably be just under $100 a barrel for Brent. Next year is going to be probably around 80 to maybe 75. But even those levels are extremely positive for Iraq. And by next year, we will have a different world economy by then. The world will have probably adjusted to that. China's COVID lockdown policy probably would have peaked by then. And then you might have a growth. But between now and next year, there is plenty to be optimistic for Iraq. And that's really the reason is I can see oil prices being much higher than their, than what is positive for Iraq. So with that, I end that. I've answered you.
Okay, thank you. And we have another question. Please discuss the safety of an investment in AFC funds. So I'm not sure from which angle you're looking at. So I think there are two. One is from an investment point of view. So basically, we are value investor in our funds. And as you can see that all four of funds, because of that, and we are also active investor that has outperformed the benchmark. So I mean, we are also linked to the performance of the world markets, but normally we outperform, especially in downtrending markets, the benchmark. So since we are long only funds, so we are not able to short stocks. So therefore, it's difficult for us to have a positive performance when everything is down. But that's from an investment point of view. From a legal point of view and an administration point of view, so we are just the investment manager. The administration of the fund and the accounting of the fund and so on is everything done by independent fund administrator. It's Trident Fund Services in Singapore. The auditor is EY in Hong Kong. The bank most of our funds use is AAA rated bank, DBS Bank, which is owned by the Singaporean government in Hong Kong. And also the custodian for some of in our countries is DBS Bank in Hong Kong. And additionally, we Asia Frontier Investments or Asia Frontier Capital is licensed by SFC in Hong Kong, which is quite a tough regulator and really very tough on supervising the investment manager. Maybe a question for Ruchir. Whilst the economic growth potential in the region is well understood, what are the political risks that could reverse this growth?
Well, I think you can break it down into, thanks for the question. You can break it down into which countries are leading growth in our universe. So for example, as I mentioned during the presentation, Vietnam is will lead growth for us in our universe in terms of GDP of 6% growth for the next, say, 4 or 5 years. And Bangladesh as well, about 6% plus, and also Central Asia, about between 4 and 5%. But if you look at the politics in these countries, it depends on the country. So Vietnam, obviously, is one-party state, has very stable politics, of a lot of political stability, and that's why you've seen so much FDI come in. Bangladesh so far has seen pretty good political stability because the government over there is supported by important partners like India, China, and the US. So I don't see any drastic change over there as well. And also Central Asia, Uzbekistan, we've seen, in fact, reforms happening there, which is actually help stability and economic stability and political stability over there. And Kazakhstan, we've seen, of course, a change in power, but I think we are past that point in Kazakhstan where there's going to be more political instability, like we saw in the beginning of the year. And also just to add a point is in terms of the political stability, I think a lot of the times this is reflected in the valuation. For example, Pakistan, right? Pakistan always trades cheap, even cheaper now at 4 times or 4.5 times PE ratio. But even before, I was trading at about 7 or 8 times PE ratio, which is a big discount to the region. So many times this political risk or political issue is embedded in the valuations. So and if you look at the longer term cycle of many companies operating in Pakistan, the fundamentals are quite good. So I would say overall, I'm not so concerned. On a broader basis, yes, country specific like Pakistan, there could be issues, but we are underweight Pakistan. And also from a fund management perspective, we diversify across countries in terms of top down. We don't allocate capital to a lot of capital to countries which have got a high political risk at this point in time. Say, for example, Pakistan. So that's the way I would look at it.
Okay, thanks a lot. So last question, and I think it's the best question from my point of view. Hi there. What is the minimum investment ticket for your funds? Thanks. So normally for non-US investors, the minimum investment size is $10,000 US. For US investors is $50,000 US. It's not discrimination. It's because of legal issues. We can only accept 100 US investors. So therefore we need to have the minimum higher. So $50,000 US for US investors. Okay, this concludes our webinar today. And since we still had some unanswered questions, we will answer them directly by email. And if you have further questions, you can always reach us by email. I hope you enjoyed this third webinar. We will organize more of these kinds of webinars in the future, and we will announce them in our upcoming monthly newsletters. Good night to our participants in Asia. To the others, enjoy the rest of the day. Bye-bye.
Good night all. Thank you for joining us.
Bye. Thank you.
Bye.